AI is about to escape the screen. Humanoid robots are walking into factories, robot dogs are patrolling warehouses, and big tech is quietly spending hundreds of billions of dollars to build what Nvidia CEO calls physical AI. In this video, I'll show you 3 picks and shovel stocks that could benefit from this new wave of embodied intelligence, from the energy that powers AI, to the factories run by robots, to the chips that serve as the brains of physical AI. This is not financial advice, but if you care about the next decade of AI investing, you'll want to watch this to the end. Welcome back to the channel. Here, we focus on the real fundamentals behind tech and AI investing, not just hype and FOMO. Over the last year, the so-called Magnificent Seven, Microsoft, Apple, Alphabet, Amazon, Meta, Nvidia, and Tesla, have been pouring tens of billions of dollars per quarter into AI. Up until now, most of that AI has lived on screens, chatbots, AI copilots, and cloud tools. You type a question, and the model replies. But the next phase of this spending is already starting. AI inside physical bodies, robots, cars, drones, and fully automated factories. In this video, I'm going to break this physical AI theme into 3 layers. The power that feeds AI and robots, the factories where robots are already boosting profits, and the chips that will be the brains of physical AI. And I'll match each layer with a stock: Tourmaline Oil, Howmet Aerospace, and AMD. Again, this video is for education only, not a recommendation to buy or sell. Let's start with the big idea: physical AI, also called embodied intelligence. Right now, most people experience AI as something on a phone, a laptop, or in the cloud. You type a prompt, you get a response. It's powerful, but it's still digital. Physical AI is different. Here, AI lives inside a physical object, making real-time decisions in the real world. That can be a humanoid robot walking around a factory, a robot dog doing security patrols at night, a delivery drone navigating around buildings, or an autonomous car processing multiple video feeds in milliseconds. Companies like Nvidia are already building dedicated hardware and software just for this, along with simulation platforms to train robot brains in virtual environments before they ever touch the real world. At the same time, manufacturers and logistics giants are quietly adding more robots every quarter. In some facilities, there are already more robots than humans on the floor. All of this is creating a new investment theme: power for AI robots and factories' chips for physical AI. Now let's look at 3 companies that sit in each of those layers. The first stock is not an obvious AI name. It doesn't sell chips, it doesn't build robots, and it doesn't make software. But without this kind of company, none of the physical AI story works. It's Tourmaline Oil, ticker TRMLF in the US and TOU in Toronto. Tourmaline is Canada's largest natural gas producer. Why does that matter for AI and robotics? Because every tech revolution is ultimately an energy revolution. Railroads were powered by coal. The car revolution was powered by oil. And the AI revolution is being powered by electricity, a lot of it. Training large AI models, running massive data centers, charging fleets of robots and electric vehicles, and powering factories full of automated machines all require huge, reliable streams of power. For the next decade, a significant portion of that power will still come from natural gas-fired electricity. Tourmaline's recent results show production at the high end of guidance, with a long reserve life, a low-cost structure. So even when gas prices are weak, they stay profitable, strong free cash flow, which they're returning to shareholders through dividends, special dividends, and share buybacks. They're also signing long-term deals linked to LNG exports and gas storage. That gives them leverage if global gas demand rises as AI data centers and industrial users compete for reliable energy. So what's the role of Tourmaline in the physical AI stack? It's a potential picks and shovels play on AI power demand, the fuel behind the data centers and robot factories. Of course, there are risks. It's still a commodity business. Gas prices can be very volatile. Climate and energy policies can change. And it's an indirect AI play. You're buying the fuel, not the technology. But if you believe AI-driven electricity demand will keep climbing, a low-cost gas producer with a strong balance sheet and generous cash returns like Tourmaline is one way to get exposure without paying typical AI valuations. The second company is where physical AI starts to show up directly in the profit and loss statement. That company is Howmet Aerospace, ticker HWM. Howmet makes high-performance components for commercial aerospace, things like engine parts, fasteners, and structural components used on aircraft from Boeing and Airbus. But the more interesting story is how they produce those parts. Over the past few years, Howmet has been investing a lot into robotics and automated production lines, 3D printing for complex metal parts, and smarter factory systems that cut waste and speed up lead times. In their latest results, you can see the effect of this automation. Revenue grew around the mid-teens year-over-year. Operating income grew closer to 30%. Margins expanded by roughly 3 percentage points in just 1 year. That's exactly what you'd expect from robots and embodied intelligence in factories. You don't just grow sales, you grow profits faster than sales. With more automation, scrap rates drop, throughput improves, on-time delivery becomes more reliable in a very tight aerospace supply chain. That improves pricing power and customer loyalty. On top of that, Howmet is generating strong free cash flow and returning capital through share buybacks and dividends, while guiding for continued growth into 2025 and 2026. Risks? It's still tied to the aerospace cycle. If aircraft production slows or airlines cut back, Howmet will feel it. Automation and robotics projects are complex. If they slip on execution, margins can be affected. But right now, Howmet is a real-world demonstration that robots and physical AI can translate into higher margins, not just hype slides on an investor presentation. The third company is one most investors already know, AMD, ticker AMD. For years, AMD has been known as Nvidia's rival in GPUs and as a CPU competitor to Intel. For a while, Nvidia clearly dominated the AI GPU story. But over the last year, AMD has taken major steps to become a serious AI platform player, not just for cloud AI, but also for the physical AI world. In its latest quarter, AMD reported record revenue, around $9 billion, roughly 36% year-over-year growth, and record data center revenue, driven by AI accelerators. At its recent Analyst Day, AMD laid out an aggressive plan, targeting more than 35% revenue growth per year over the next several years, expecting the AI data center business to grow even faster than that, and rolling out a roadmap that goes from today's MI300 and MI350 series to future MI450 racks and MI500 series later this decade. So how does this connect to physical AI? Think of AMD in 2 layers. First, the cloud layer. Their MI350 and upcoming MI450 accelerators are used in large data centers to train and run AI models. These are the models that will eventually control fleets of robots, humanoids, drones, and autonomous vehicles. The smarter and more capable those robots become, the more compute demand you see in the data center. Second, the edge and embedded layer. AMD also sells embedded processors, FPGAs, and semi-custom chips. This is where physical AI hardware lives, in industrial robots, in drones and defense systems, in specialized controllers and smart machines on the factory floor. One of AMD's key selling points is value and openness. They focus aggressively on performance per dollar, trying to win customers who care about how many AI tokens they can process for each dollar of hardware. They're building around an open software stack called ROCm, which appeals to companies who don't want to be tied completely to Nvidia's ecosystem. If AI data centers spending and physical AI deployments continue to grow, AMD has a real shot at becoming the second pillar alongside Nvidia, providing the brains not just for chatbots, but also for robots and intelligent machines. But there are important risks. Nvidia still has the stronger ecosystem, market share, and reputation in AI. AMD's long-term growth targets are goals, not guarantees. Everything depends on execution, from manufacturing and supply to software to winning big cloud and enterprise customers. Still, as a way to play the compute side of both digital AI and physical AI, AMD is becoming very hard to ignore. So let's bring it all together. If you believe we're entering a physical AI decade, you can think about the opportunity in 3 layers. Power. Companies like Tourmaline that may benefit from the massive, always-on electricity demand created by AI data centers and robot factories. Factories. Companies like Howmet Aerospace, where robotics and automation are already showing up as higher margins and stronger profits. Brains, companies like AMD, building the compute engines that train AI models and eventually run the robots themselves. None of these stocks are risk-free. Energy prices move. Aerospace cycles can slow down. AI spending can surprise to the upside or the downside. And this video is not financial advice. Always do your own research and understand your own risk tolerance. But if you're tired of hearing only Nvidia, these are 3 different ways to get exposure to the same mega trend: AI leaving the screen and entering the physical world. Let me know in the comments. Which layer do you prefer? Power, factories, or brains? And what other physical AI stocks are on your watch list? Thanks for watching, and as always, happy investing.